Good day, everyone, especially to you, Sir Malong. My name is Wendelin Paglilingan, and we are the Group 10. Our topic is about interest risk management. Interest risk management involves identifying, measuring, and mitigating the risk associated. It involves strategies and techniques used by individuals, businesses, and financial institutions to mitigate the potential adverse effects of fluctuations in interest rates on their financial positions. How important interest rate risk management? Well, it is important for businesses, particularly those with significant exposure to debt or interest sensitive assets like stabilizes cash flows. Fluctuations in interest rates can lead to unpredictable interest expenses or income. Interest rate risk is the risk that changes in interest rates will adversely affect the value of an investment or a financial instrument. Halimbawa nito, kung ang interest rate ay tumaas, ang halaga ng mga bonds na hawak ng isang investor ay maaaring bumaba dahil ang mga bagong inilabas na bonds sa capital market ay nag-aalok ng mas mataas na interest rate. Kaya ang luma ay nagiging mas kaunti ang halaga. Interest rate risk arises due to fluctuations in interest rates. It affects both borrowers and lenders. Due to fluctuation means that interest rate risk arises because rates do not stay constant. It's fluctuate, they change time by time. These changes can be caused by various factors such as economic conditions, monetary policy, market demand, global events, and these fluctuations means that the interest rates go up and down over time, creating uncertainty for investors, borrowers, and financial institutions. Types of interest rate risk. There are three types of interest rate risk. First one is price risk. Second one is reinvestment risk. And the last one is cash flow risk. For price risk, this refers to the risk that the market value of fixed income securities will decline when interest rates rise. Example of price risk. A wheat, a wheat farmer who plants in the spring expect to sell the harvest in the fall. If wet prices drop significantly by harvest time due to factors like weather conditions, supply and demand changes, or economic events, the farmer will earn less than anticipated, potentially not recovering production cost. For reinvestment risk, this is the risk that future cash flows from an investment will have to be reinvested at lower rates, leading to lower returns. Example, it can be seen in fixed income securities like bonds. Let's say an investor purchases a 10-year bond with a 5% rate. The investor expects to receive interest payment annually for the next 10 years and the bond's face value at maturity. However, if interest rates decrease after the bond purchase, the investor might face reinvestment risk when the annual interest payments or maturity amount are reinvested at the new lower interest rate. For cash flow risk, this risk arises when changes in interest rates affect the cash flows of an investment or a business. Example of cash flows. It can be seen in small businesses like small restaurant that relies on a steady stream of customers for its revenue. If there's a sudden economic downturn or a local event that reduces foot traffic, the restaurant may experience lower than expected sales. This decrease in sales can lead to cash flow risk because the restaurant may struggle to cover its operating expenses such as rent, utilities, payroll, and suppliers' payments. Without sufficient cash flow to meet these obligations, the restaurant may face financial difficulties, including the possibility of defaulting on loans or facing liquidity problems. interest rate risk management strategies, there are two: duration matching and asset liability management, or ELM. Duration matching, matching the duration of assets and liabilities, helps in reducing interest rate risk. This means aligning the time periods of when your investment generates cash flows or assets with when you need to pay of debts. Debts means liability. Example, if you have long-term liabilities with fixed interest rates, matching them with long-term assets rate changes affecting your ability to meet obligations. For asset liability management, involves managing the balance sheets to minimize interest rate risk. This includes diversifying the maturity and repricing assets and liabilities. This means managing the balance sheet to minimize interest rate risk involves several strategies, including diversifying the maturity and repricing of assets and liabilities. Ito ang halimbawa ng diversifying maturity, repricing assets and liabilities. By combining these strategies, financial institutions can better manage their exposure to interest rate fluctuations, reducing the potential negative impact on their balance sheets. That's all my part. Thank you.
Good day. I am the last reporter for this topic, interest risk management. So first, in this topic, I will discuss what is using derivatives in interest risk management. So, using derivatives in interest risk management involves here using financial instruments such as interest rate swaps, options, and also future contracts to hedge against fluctuations in interest rates. So, by utilizing derivatives, companies can protect themselves from potential losses uh, due to due to changes in interest rates. So, which can impact their borrowing costs and investment returns. Uh, and using derivatives in interest risk management, it can help companies manage the risk exposure and better plan for future financial conditions. So the second one is floating rate instruments. So floating rate instruments, investing in floating rate or loans can help mitigate interest rate risk as their returns adjust with changes in interest rates. So, based on my understanding, and floating rate instrument in interest risk management, it is a financial security or loan that 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 has an interest rate that changes periodically based on underlying benchmark interest rate. So the interest rate on floating rate instrument, it is typically adjusted at a regular intervals such as monthly or quarterly based on changes in market interest rates. So this type of instrument nag-provide siya ng protections against the interest risk against interest rate risk. So as the interest payments nag-a-adjust sab ini siya to reflect changes in prevailing interest rates. So nag-allow sab ng investors to benefit from rising rates and mitigate losses in declining rate in environment. So in the third one is importance of stress testing. So stress testing in interest rate risk management, it is a crucial interest rate as it helps financial institution para ma-evaluate niyan the potential of impact of extreme market conditions on their balance sheets. So by subjecting their portfolios to various hypothetical scenarios, institution can identify vulnerabilities, assess the adequacy of the risk management strategies, and gi-ensure sab niya sufficient capital reserves to withstand adverse events. So this proactive approach enables institution to make informed decisions, strengthen their risk management practice, and better prepare for unexpected changes in interest rate. So the next is regulatory consideration. So when we say regulatory consideration in interest risk management, it involves compliance with laws and regulations set forth by the regulatory bodies such as Federal Reserve and the Office of the Comptroller of the Currency. So financial institutions uh, are the required to adhere to specific guidelines regarding the measurement, monitoring, and management of interest rate risk to ensure the safety and soundness of financial system. So, inisyal ng mga regulation, it typically include requirement of risk exposure limits, stress testing, reporting, and governance practice to mitigate the potential impact of interest rate fluctuations on institution and the broader economy. So, compliance with regulatory standards is essential to maintain the financial stability and uphold the integrity of financial system. So, in the next is risk monitoring and review. So when we say risk monitoring and review in interest rate risk management, so it involves subsidiary and continuously assessing and evaluating the risk associated with interest rate fluctuations. So kumulang kita fluctuation, amo yan siya ang pagbaba ng isa ka price, pagbaba pagkalit. So this process includes monitoring key risk indicators such as duration gap, earnings at risk, and other rate metrics para ma-identify sab nato ang pagbago ng isa ka risk exposure and assess the effectiveness of risk management strategies. Regular reviews of the interest rate risk profile help institutions stay informed about potential threats, make informed decision, and adjust risk management practice as they needed to align with the institution risk tolerance and strategic objectives. So, by conducting ongoing monitoring and review, an institution can proactively manage an interest risk management. So, mitigate potential losses and enhance overall financial stability. So, the last one, for the second for the next slide is communication and transparency. So when we say communication and transparency in interest rate risk management, so it involves sharing information. So syempre from the word communication, for the information get nisa or sharing information. So it involves sharing information about the institution risk exposure. So strategies and risk management practices with key stakeholders such as regulators, investors, and internal management. So by maintaining open and clear communication channels, institution can promote a better understanding of the risk they face. So it enhances trust and credibility and facilitate informed decision making. So sa transparency isab, it helps stakeholders assess the institution risk management practices at it ensure alignment with regulatory requirements and provide assurance that institution is effectively managing interest rate risk. So, effective communication and transparency are essential for promoting accountability, maintaining confidence in the institution, and fostering a culture of risk awareness and responsibility. So, for the last topic for this chapter 10, so is implementing robust interest rate risk management. So when we say implementing robust interest rate management in this chapter, it involves creating comprehensive framework that identifies, measures, monitors, and controls risk exposure related to fluctuation in interest rates. This process includes establishing clear risk management policies and procedures. So, conducting a regular risk assessment by utilizing sophisticated risk measures models, setting risk limits and thresholds, implementing effective hedging strategies, and conducting stress tests to assess the impact of extreme scenarios. So, for this last Additionally, for this last, robust interest rate risk management, uh, it involved fostering a risk-aware culture, providing ongoing training to staff, maintaining open communication and transparency, and also ensuring compliance with regulatory requirements, and also by implementing a robust risk management framework, institution can effectively mitigate interest rate risk. So, naga-protect sab siya their financial stability and naga-inform decision to achieve their strategic objectives. So, that's all my part. Thank you.